Welcome back to the Global Ledger. I'm Justin. In the last episode, we revisited Basel, not as a rule book, but as a force that reshapes liquidity itself. Today, we're going to go deeper because once you understand how regulation changes behavior, you're forced to confront an uncomfortable truth. You cannot maximize capital safety and market liquidity at the same time. Every regulatory system makes a choice, and today's episode is about the trade-offs that choice creates. Trade-offs that are rarely discussed openly, even by regulators themselves. Let's get into it. Capital regulation answers one core question: how much loss should an institution be able to absorb without failing? Capital rules, limit leverage, increase shock absorption, and reduce default probability. From an institutional perspective, this is a success. Banks today are safer, better capitalized, and more resilient than they were in prior decades. But capital regulation does something else, quietly. It makes risk expensive to hold. Liquidity regulation answers a different question. Can an institution survive short-term funding stress? Liquidity rules require high-quality liquid assets, limit maturity mismatch, and force contingency planning. They reduce run risk, but they also lock balance sheets into defensive postures. Capital regulation discourages risk. Liquidity regulation discourages intermediation. Together, they reshape markets. Here's the tension. We're going to talk about where the trade-off emerges. Capital rules punish inventory holding. Liquidity rules reward holding safe, liquid assets. Market making requires holding inventory. Market liquidity requires balance sheet usage. You can have strong institutions or deep markets, but not both at maximum strength. This is not a failure of policy, it's an optimization constraint. How does this show up in real markets? This trade-off explains thinner dealer inventories, wider bid-ask spreads during stress, reliance on non-bank intermediaries, sudden liquidity gaps, faster, more violent price moves. Markets didn't become fragile by accident. They became efficient under constraint. Why does risk move and not disappear? Regulation doesn't eliminate risk. It relocates it. Risk migrates from banks to hedge funds, from balance sheets to markets, from slow institutions to fast ones, from visible leverage to hidden leverage. The system looks safer, but it's also more sensitive. Here's the dilemma regulators face. If you loosen capital rules, liquidity improves, intermediation expands, but institutional risk rises. If you tighten them, banks become safer, markets become thinner, and stress concentrates elsewhere. There is no free lunch, only trade-offs. And this matters for market stability. This helps explain why central banks step in directly. It explains why facilities replace balance sheets. Liquidity backstops become permanent. And market plumbing matters more than policy signals. Markets now rely on structure-aware intervention, not just rate changes. And we connect this up with Arc 9. Arc 9 is about how regulation, technology, and infrastructure reshape markets from the inside. Capital and liquidity rules are not background noise. They are the operating system. And as I set us up for episode 83, I think we're ready for the next question. If balance sheets are constrained and liquidity is fragile, where does risk concentrate? In episode 83, we'll examine one of the most important structural shifts of modern finance. This is central clearing. We got to ask ourselves, is it a stability engine or concentrated risk? Because when you move risk out of banks, you don't destroy it. Somebody else is taking it. You centralize it. So that's next. Thank you for listening to episode 82 of The Global Ledger. I'm Justin, and thank you for being here.